If you're self-employed and you're using a simple IRA or a SEP IRA, you're likely leaving money on the table. In this video, I'll talk through why I rarely recommend simple IRAs or SEP IRAs to clients of mine and what to do instead. At the end, I will talk about the rare cases where SEPs or simples make sense. The problem is that if you're self-employed, it's your responsibility to set up your own employer-sponsored retirement plan if you want to do tax privilege investing outside of just an IRA. Many business owners set up plans on their own or follow the bad advice of a CPA or financial advisor who aren't retirement plan experts, and they get a simple IRA or a SEP IRA because it was cheap to set up and easy to administer. I want to talk through 7 limitations that these plans have compared to a solo 401k. Number 1 is that simple IRAs and SEP IRAs don't carry the same type of creditor protections that you find with 401ks, and it varies pretty widely state to state. Number 2 is that the contribution limits to simple IRAs and SEP IRAs are significantly lower than in a solo 401k. Number 3 is that they have less flexible funding. In a simple IRA, you can put in employee contributions and a small employer match. In a SEP IRA, you can only put in employer contributions. And in a solo 401k, you can do both. Number 4, simple IRAs and SEP IRAs are treated as tax-deferred individual retirement accounts, which messes up the backdoor Roth process, which is particularly important if you're a high earner. Number 5, there's not a clean option for doing Roth investing with a simple IRA or SEP IRA. Now, the Secure 2.0 Act did introduce Roth SEPs, but many platforms haven't introduced the Roth feature on their platform, so even though it's allowed by the IRS, it's not necessarily feasible to do pragmatically. You can convert from a SEP IRA to a Roth IRA immediately, but dollars converted into a Roth IRA can't be removed immediately the same way contributions can. They're subject to an additional 5-year rule, or you'll be subject to a penalty. With simple IRAs, you can also do conversions from the simple IRA to Roth, but not within the first 2 years that the plan is established, and you run into the same problem that you do when converting from a SEP IRA to a Roth. Number 6, you can't borrow from simple IRAs and SEP IRAs the same way you can from a 401k, which is typically limited by 50% of your 401k value. And number 7, as soon as you hire an employee, if you do, SEP IRAs and simple IRAs become pretty restrictive. 401ks provide more lenient funding options and allow you to have vesting schedules, so if someone leaves after working there for a year, they may not be eligible to take certain employer contributions with them. That's not the case in simple IRAs and SEP IRAs. So why do people choose SEP IRAs and simple IRAs? It's primarily because they're cheaper and they're easier to administer. If you're setting up a solo 401k, depending on the features that you want, it could cost $0 to set up, or it could cost as high as $1,000 or more to set up. Again, the more bells and whistles that you include. Maintaining SEPs and simples is also easier because you don't have annual filings with the IRS like Form 5500 that's required for solo 401ks with a balance over $250,000. Most of the time, I've found that solo 401ks tend to be a better option, primarily because of their flexibility in funding. First, we'll talk about the funding options with simple IRAs. So the annual contribution limits for 2026 for simple IRAs is $17,000. If you work for a smaller employer, 25 employees or less, it may be as high as $18,100. There's also an additional catch-up amount that you can contribute to simple IRAs if you're over the age of 50. That catch-up amount is $4,000. If you're between the ages of 60 and 63, the catch-up amount is $5,250 instead of $4,000. The catch-up does change a little bit if you work for a smaller employer. In terms of employer contributions, employers can make one of 2 types of contributions to a simple IRA, and I'm just going to oversimplify it a little bit for the sake of this video. First, they can make non-elective contributions, meaning anyone who's eligible for the simple IRA is going to get a 2% contribution from their employer, or they can do a matching contribution, in which case typically the match is going to be set at 3%, and as long as the plan participant is contributing 3%, they're going to get an additional 3% match from the employer. SEPs, on the other hand, look a little bit different. They don't allow employee contributions, they only allow employer contributions. And so you can only contribute for yourself as the employer. You cannot contribute for yourself as the employee of your business. The employer contributions are going to be limited to either 25% of the wages you pay yourself if you're filing as an S-Corp, or 25% of the net earnings of the business. So why do I typically recommend for people in this position to do a solo 401k instead? First, we have to define what is a solo 401k. Think of it like any other 401k. It actually falls under the same rules on the IRS. It's just going to be limited to a business where you're the only employee or you and your spouse, assuming that there's no control groups. Solo 401ks allow you to put away more dollars with the same income. They provide creditor protections. They don't mess up the backdoor Roth strategy for our higher earners. You can do loans from the solo 401k. It's easier to adapt if and when you do hire your first employee that's not your spouse. And the funding is just way more flexible. Let's talk a little bit more about how funding works in a solo 401k. So in a solo 401k, you can make the employee contributions up to the $24,500 limit for 2026, plus a catch-up if you're over age 50. You can also make employer contributions to the solo 401k, limited to 25% of the wages, again, if you are filing as an S Corp, or 25% of the net earnings if you file on your Schedule C. You can also do after-tax contributions into the solo 401k. That's going to be different from Roth. I have another video that I'll link here that walks through exactly what the differences are between Roth contributions and after-tax contributions. But those after-tax contributions don't necessarily have a limit other than the total additions limit, which is $72,000 for 2026. So you can make significantly more contributions if your solo 401k plan allows after-tax contributions. That's an option that's not available in simple IRAs and SEP IRAs. I'll show you a few examples here of how much you can put away based on different income levels for a solo 401k, a simple IRA, and a SEP IRA. So first we're going to look at an unincorporated sole proprietorship for someone who is making $100,000 per year. And we're going to say they're age 30. You can see here that the maximum contribution they can make to the solo 401k, let's do 100,000, is $43,000. And if we're looking at the SEP IRA or the simple IRA, the maximum contribution amounts are much less, again, because of limitations on the types of funding that you can put into those accounts. It is going to differ slightly if you are filing as an S corporation. You can see here the number is a little bit cleaner because it's not doing the longer calculation that you need to determine self-employment income if you are Schedule C. So for that same individual, again, you're able to put away significantly more into the solo 401k. Let's see for someone who is at a lower income threshold, for example, they make $40,000 and they're filing as Schedule C. Again, the solo 401k allows significantly more contributions than the SEP IRA, the simple IRA. Let's see if it holds true for higher earners as well. Let's say this individual is making $400,000 a year and is filing as, let's say $250,000 a year and is filing as an S Corp. So they can put away the $72,000 total additions limit. If they're over age 50, they can do the catch-up as well, still able to do more than the SEP IRA or simple IRA. So what are the downsides of doing a solo 401k as opposed to a SEP IRA or simple IRA? There's really just two. One is that it's a little bit more complicated to set up. Oftentimes you're going to need to work with a TPA or a financial advisor who's familiar with setting up solo 401k plans to make sure that you design your plan appropriately. Again, I have a separate video that walks through plan design features and deadlines that I'll link that may be helpful for you. Also, the costs are a little bit higher. What I've found is that for most business owners who are switching from a SEP IRA or simple IRA over to a solo 401k, they do have more cost in the terms of plan setup and administering the plan over time, but they typically have greater payroll tax savings because they're able to pay themselves less and still make the same retirement contributions that they were desiring to make before. So I told you that I would answer the question, well, who should use a SEP IRA or simple IRA? And there's only a few scenarios that I've run across where I thought it made the most sense. So the ability in SEP IRAs to make employer contributions, you're able to do the same thing in a solo 401k. So in most situations, we're not losing anything by switching from the SEP IRA to the solo 401k. So who then should still be using a SEP IRA? There's one certain situation that makes sense. That situation is if your minimum reasonable compensation is already greater than, for 2026, $288,000, then you can make all of your contributions as employer contributions pre-tax. Most of the earners who are at that threshold are aiming to do pre-tax contributions anyway. and they can accomplish everything they need to within the SEP IRA. And this would avoid the setup cost that you'd have with something like a solo 401k. So who should do a simple IRA? I've heard other advisors say things like friends don't let friends do simple IRAs. Now, if you're the person who's in the situation where you only want to do pre-tax investing, you're not planning on doing any Roth conversions, and you're planning on putting away an amount each year that is less than the simple IRA contribution limit, then the simple IRA is going to be cheaper and easier than setting up a solo 401k. Oh, and one more thing, you have to be certain that you're never going to introduce another employee. Outside of those few situations, 90% of the time I find the solo 401k makes more sense. Again, there are other cases, but these are the ones that I most commonly come across. If you're a business owner and you're trying to figure out what plan to set up for your business, or you have a simple IRA or a SEP IRA, and you're wondering if you should transition to a solo 401k or even a multi-participant 401k, feel free to reach out to us. We can help you do an analysis and figure out which plan makes the most sense for you and for your financial plan going forward. If you are thinking about setting up a solo 401k or you want to max fund it this year, I have another video here that I'll link that walks you through how to do that well.